I bet, somewhere not far from the George Washington Bridge where we used to meet in Fort Lee is Ron Insana. He is, of course, in my mind, first and foremost known as an OG of CNBC. He was there when it was the Financial News Network. I mean, he was low down in Los Angeles, worked his way up the ladder. FNN was acquired by CNBC, and I grew up watching him, man. I had the bar mitzvah money that I put to use watching you and Bill Griffith and Sue Herrera. He is now in 2026. Message of the Markets is his Substack, and you always see him on Business Analyst on MS Now, the former MSNBC. Is that correct, sir?
That is absolutely correct, sir. Thanks for having me.
It was such a treat for me to watch you when I was in my money management job out of college, and then to do CNBC with you, I believe, on the floor of the New York Stock Exchange.
Yeah.
And we are approaching the 25th of 9/11, and you were there, and very vividly, I remember you reporting it. I wanted to start this with a jump ball. Can you imagine how much has changed in terms of the monoculture, in terms of things that would be reported on CNBC or reported on the Wall Street Journal? Now, a quarter century later, we are so dispersed. There's so much information. There are so many trillion-dollar companies. There's social media. There's Twitter, which is owned by a billionaire, soon to be trillionaire. There is social media. You process your stuff on Substack, but I also see your reels on Instagram. I mean, what goes through your head when you try to process these changes?
It depends who I'm talking to. I mean, with my kids, they're like, Dad, you can't just do TV anymore. You need to do 2 reels a day. You need to build your following. You need to use Claude to write your 3-second hook for the top of your reel. You need to get it on YouTube. We have to put it on TikTok. Back in the day, you go to work for CNBC, you do 3 hours on the air and you go home. It was, or going back even farther to Financial News Network. When I started in 1984 and I got on the air in 1985, the market was open from 10 to 4. And I had joked once right after the CNBC merger that this was as close to a social service job in TV as you could have. And then they started after hours just a little bit. Then they opened the market at 9:30 instead of 10, which caused an uproar on Wall Street. Then you added hours before and after. Then all this stuff, then, beyond cable, streaming, social media, all the things now that we have to include in our repertoire Substack to keep, maintain, build an audience. It's really mind-blowing relative to where we started. When I was at FNN in 84 as a production assistant, I was standing at the paper wire machines for 10 hours a day, tearing wires and handing out scripts. That was my whole job.
And they didn't give you a Quotron login or anything? I mean, this is
one, we didn't have Quotron. We used ADP.
I used that too, ADP and Bridge.
We were not allowed to have the Dow Jones Newswire because we competed with them, and so they wouldn't sell to us. So we had AP, UPI, Commodity News Service, and Reuters. And those were the 4 news services that we had. And you'd literally stand there all day long. And as the stuff came off the wire, you'd rip it. Reuters used to come in these what they call takes. The story bits were about this big, and there could be 16 of them. And it was double paper. It was carbon, kind of type thing. And you had to tear each take, staple the story together, and then hand it to a producer or an anchor or an assignment editor to get it written and get it on the air. I mean, it sounds so ancient now, when everything's just included either on your phone or your laptop or your desktop. And, it was what it was. We had paper scripts. We had a teleprompter operator who rolled a paper script down. And if it ever got out of control, the entire script would shoot off the conveyor belt. And everybody would have to look down, just to be able to read and find out where they were in the show. It was crazy, but it was also exciting and fun at the time too.
And I also think, isn't it crazy to look at a long chart of the Dow or the S&P 500 and to see how tiny and de minimis the crash of 87 was. But when you were there, and I recall also Bill Griffith of CNBC, you could go look him up on YouTube.
We were at FNN. We were at
FNN. He was interviewing, I think, Paul Tudor Jones. It was a PTSD engendering moment. But no one can believe those things right now. Circuit breakers, the volumes were so minuscule compared to what we see today.
Yeah, but the tape ran, I think 3 or 4 hours behind the day of the crash. So I was visiting a buddy of mine who was in medical school in Chicago, and we used to do a show called The Options Report every Monday morning at 10:30 Eastern time. And so I decided that particular week, and I got there on the weekend before, to visit my buddy that I've known since I was 13. He's in med school at Northwestern. So I go out to Chicago, we're hanging out. And I asked Bill, I said, hey, they have an options trading class Monday, Tuesday, Wednesday. We do the show on Monday. Can I do a hit from the CBOE Monday morning, which happened to be October 19th, 1987. So I spent my entire weekend. This was my first live reporting experience ever.
From the pits of the Chicago Board of exchange?
From the options exchange first. Then I went to the Board of Trade and the Merc as well and reported from there. And just that first full day at the CBOE, when guys are blowing up around me and, business was going nuts, we're down, 508 points. I met John Najarian on the floor. He was the largest independent at the time. Tom Bond was the IBM market maker. And then you went over to the CBOT, the Board of Trade, where bonds traded, and Tom Baldwin, who was the biggest guy in a pit of like 1,000 men, standing shoulder to shoulder as bond money's just rushing into the bond market. It was this eye-popping.
Was it like the scene in Trading Places with the orange juice futures report?
Yeah, very much like that. Actually, it was maybe even a little crazier because it was
Mortimer, we are ruined.
You have to turn the machines back on. Everybody wanted to turn the machines off on that day because it was so bad. I mean, the funny thing, the ironic thing was we went out and did man on the street interviews after the crash, and retail was so uninvolved in the markets then that no one cared. Mom and pop were not. No, you're asking people they're like, what do you mean the stock market goes down? Who cares? Literally, who cares? We were down 23% in a day and no one cared, but nobody was involved. It was really, at the end of the day, it was largely a professional event that decimated Wall Street for months, if not a couple of years afterwards, but had virtually no impact on Main Street.
Now let's shift to the 1990s. I think when I came of age, I mentioned my bar mitzvah money. And now, I talk to my kids about it, the bar mitzvah multiplier, kid. You could take the $1,000 and spend it on Starbucks gift cards, or you could wait 40 years and it'll be worth 40x if the S&P whatever. Yeah. So shut up, Dad. But the 1990s really did. If you remember the Merrill Lynch ad on FNN CNBC, we're bullish on the 90s.
Yep.
And that's when I came of age, took my job out of college. I worked at the brokerage firm. I worked at Goldman in asset management. There was this IPO boom, and mom and pop were absolutely involved, Ron. I was getting calls from Iranian relatives that I did not even know I had saying, Farzad, your mother told me you can't talk about the Cisco. I swear, I would go to a funeral. Somebody would be digging dirt, would look up at me, record scratch moment. Farzad, JDS Uniphase is good. Yeah. I mean, that set up everything else that happened, and subprime and the early aughts and whatnot. And I'm setting up for the 2026 talk, but that's when CNBC, it was even being plugged on The Sopranos. Or the Ramones had a song about Maria Bartiromo.
That was January of 2000. It's funny you mentioned that because I just noticed that CBS is doing a show called Cupertino.
Mm-hmm.
So and I mentioned this to Edie Falco, I was at a premiere once. It didn't go over well with her, but I said, in January of 2000, you said, when she was trading stocks and Tony comes in and said, you're trading stocks. And she goes, hey, I'm informed. I watched that CNBC. That was the absolute top in the market. And I mentioned that to her and she's like, yeah, I'm glad I could help. She wasn't really pleased with the way I phrased it. But there was another day prior to that, on CNBC, I was interviewing a gentleman by the name of Peter Henderson, who was a specialist on the floor of the New York Stock Exchange. And this is December 23rd, 1999. And we're talking, and we always, at the top of the 3:00 show when I was doing Street Signs, we either interview the late, great Art Cashin. Once a week. And Peter was one of the specialists that we talked to. And he stopped me in the middle of our conversation. And he said, I was walking to the exchange today and there's a homeless gentleman who always asked me for money on the way to work, and I gave him some money. And this particular day, he stopped Peter and he said, do you work at the exchange? And Peter said, yes. And he goes, can I ask you about an internet stock? And at that point, not to condescend to anybody who is in, very, very difficult circumstances, but when a homeless guy is asking you for a tip on an internet stock, you're so far past the shoeshine boy Joe Kennedy story from 1929. Everybody was in. There was no one left to get in. And so you knew it was the top. And so now when I see Cupertino ads on CBS, I'm like, and it's about lawyers in Silicon Valley, right? Taking on big tech. We're pretty close to the top.
And then didn't the go-go NASDAQ peak to trough fall something like 80%?
The 78%.
Into 2002. And that washed out what I thought was a generation. But here's the fascinating thing to me. It all set up the mortgage bubble and subprime. And the true crash of our lifetimes was 2008. 2009, when you had fund managers, as you know, bond fund managers saying, low key, I would take $10,000 out of the ATM and put it under a mattress. Something is amok.
I did that.
People walking out of Lehman Brothers with their wares. But let's compare that calamity. I thought generationally we would never see, we don't see NASDAQ 5,000 in decades. We are at multiples of that. There are so many companies worth more than $1 trillion now. And even if you normalize that for inflation, and what we want to get into is the extent of this AI build out. What used to be stunning capital spending in the hundreds of billions of dollars is trillions of dollars right now. And the valuations have kind of reached the Y2K peak valuation levels. Yeah. But now I'm starting to get accosted by people again and are just saying that it definitely feels like a bubble. And I don't have any neat answers. I can study 87. I can study 08. I can study the crash of 29.
Yeah, it's and look, they're all the same. They're just dressed differently. I always think of a line in Macbeth when he's first approached after, I guess it's the Thane of Cawdor dies, and they approach him as, Thane, or, kind of like Lord. And he's like, why do you dress me in borrowed robes? The Thane of Cawdor lives. And it's like the borrowed robe is, from each period, like it looks different, but it's really the same, and it gets an elevated status, and everybody thinks it's different this time, which is the, worst expression in the history of financial markets. And it's not really. The problem is always, though, as you know, Robin, it is when. You can't really pick the time at which it's going to break. And you don't know exactly what the particular incident is that's going to break it. Typically it's higher interest rates, or it's a failure of some really, really important company to deliver on its promise, or a combination of the two. And I think that's kind of what we're waiting for, looking for, certainly hoping not to see. But we all, those of us who've studied this as you have and as I have, we know it's coming. You just can't pick the day.
And does it interest you also, having covered multiples of this, the correct doomsayers of, say, the crash of 87, the Garzarellis, Nouriel Rubinis, the Dr.
Gloom, whoever.
Dr. Gloom, all of them. No, Michael Burry or whatever, the glass-eyed doctor.
2008, yeah.
They never, they say the broken clock is right twice a day. But they never seem to call the successive one. There was Meredith Whitney worrying. Nobody remembers this, about a big muni bond
crash,
bust up. But that's the fascinating thing about these things. We know something must be going on. Some sort of subprime falafel must be being rolled right now, but we don't exactly know who's going to call it correctly.
Yeah, look, when you go back, Meredith, kind of also stepped out of her lane a little bit. She was a bank analyst who started, there were problems in the municipal bond market, but not to the extent, to which cities were going bankrupt in droves. We had one, municipal bond bankruptcy in Connecticut, which didn't even really last at the end of the day. And Detroit almost went bankrupt, but that was not the fiasco that was at hand. It was really, ultimately, it was the mortgage crisis and, collateralized debt obligations and credit writ large, taking down the entire banking system. I was at SAC working for Steve Cohen. I started a week before Lehman collapsed. And it was, you talk about people taking money home. There was, I could probably say this, I signed an NDA ages ago, but there was a guy sitting behind Steve who took 3 years of income out of the bank, bought a safe and a gun, and brought it all home, even though he was going to work every day. So I was so freaked out when I heard that I called my wife, and you said, taking 10 grand out of the bank. Our kids were little, still in diapers to a certain extent, or around that age. And I said, honey, I'm going back and forth to Stanford, so I'm not going to make it to the bank at any time. I'm leaving in the morning, coming home late at night. So take $5,000 a day out of the bank, call them in advance, tell them you're coming, do that for a week, put it in my right-hand drawer. And,
at least Tony Soprano put it in the bird feeder container, to hide it from Edie Falco. That brings it back to her.
Yeah. So, right. So, right. Full circle. But no, we did that. I had $25,000 in the house just in case, it really hit the fan, in the sense that they would shut the banks like Roosevelt did in the 30s. And we were absolutely terrified that they were going to do that at some point, create a bank holiday, because we were so close to systemic, financial failure. We were within either hours or days, depending on whether you're listening to Mervyn King, who was the head of the Bank of England at the time, or Ben Bernanke, who later said it was 48 hours away. Mervyn King said it was 3 hours away from the entire global banking system collapsing. So, that was, in many ways, that is still, I think, maybe the defining crash of our era. It had a much more profound impact on Main Street. And if you look at generationally, when you look at the millennials and Gen Z, they either saw their parents experience it and run out of money, or, change careers, or be wildly affected by that. And then you throw the pandemic on top of it, their generation, their mindset, was affected. And yet millennials, Gen Z, are very aggressive investors, and they're also inveterate gamblers in many cases as well. They seem undeterred by any of the shocks that we've experienced over the last 20 years.
Full disclosure, I'm Roben Farzad. It's a joy to have Ron Insana. He is in my heart a CNBC OG. He was there in the early 80s, and up until a while back, he was a contributor, but now he is often on MS Now, the former MSNBC, and his message of the market, Substack. I got to tell you, I have another snapshot recollection. I was at Business Week covering Wall Street back then, and we were in the process of being sold to Bloomberg. But one of my great sources took me out for what I thought would be one of my last expense account lunches ever. There was a place on 57th and 7th, an Italian restaurant that had like a brass butt that everybody would polish on the way in. It had an ear on the wall or whatever. It had an incredible tuna fillet, and I savored it because it would be the last thing. And I remember this great hedge fund source telling me, I just don't see how we're going to get out of this. I just don't see how we recapitalize the banks. You saw PIMCO with the new normal prophecy that this would be a long period of deleveraging, a credit overhang, a long, long time of persistently low rates and companies selling stock. And fast forward it for you. The S&P 500 goes on for the last 17 years since that moment to compound at about 17% total return, which is a breathtaking bull market. We did have some corrections, a bit of a bear. We saw what happened in COVID where the market was very briefly down 30%, but then everybody started speculating again. It shows you that nobody and by the way, nobody back then could project crypto, much less the AI build out.
No. I mean, look, I think, first, thank God for Ben Bernanke, who was a student of the 29 crash and the Great Depression and, used that to create the underpinnings for, zero interest rate policy, unconventional monetary policy, which included quantitative easing or bond buying to bring interest rates down and re-liquefy the banks. That, the government bought the equity of banks and recapitalized the banking system. And they did this, however, kind of spottily it occurred. Ultimately, I'd say by November of 2008, you had the makings of the bottom, even though it took us until March for the stock market to bottom out. They were putting in place.
I mean, they were worried about Citibank failing.
They were worried about everything.
Well into the spring. Yeah. I mean, AIG was asking for more money,
Goldman,
right? It was about.
Goldman never got really bailed out, but they had to take the money, right, to show that it was a uniform, infusion of capital so that everybody was solvent, and then, they shot Lehman and disposed of that through Barclays. But, ultimately the policies that were enacted, I think, certainly by Bernanke were extraordinarily helpful and, set the stage for recovery. It took a long time, and it took a long time for housing to recover. It took a long time. Inflation stayed under 2% for a dozen years at least. There's something that our current Fed chairman got entirely wrong. He was fighting with Ben Bernanke over zero interest rate policy and QE, saying it was going to create hyperinflation. And that was something in that environment that we never saw.
One final footnote on this. I would ask you this, and if I saw you at a cocktail party, whatever happened to those quote unquote toxic assets that were sinking the banks? There were this like 60 Minutes. I remember watching a woman just mailed her keys back to the bank. There were these homes in the exurbs of Arizona that were literally taken over by coyotes and bobcats. People had ripped out the copper pipe, the sheetrock, and everything. These were brand. No one today would believe that because housing has been so white hot. But those bad bank toxic assets in your mind, because you were in the hedge fund world, were there great vulture investors that snapped these up and said, "I'm going to wait for them. I'm buying them at such distress, blue light sale levels.
Yeah,
I'm going to make bank."
I mean, I'm not sure that they were, they were probably buying bits and pieces of CDOs or collateralized debt obligations that, had some residual value. But I think really what happened was people started buying real estate. I mean, and once you underpin the reference asset, which was residential real estate, really for the most part, and mortgages, they were certainly buying mortgages for sure, right? I mean, everybody went in and bought mortgage securities. And that really helped to turn things around as well. You had the, as you call them, the vulture investors went in and you were buying either mortgages or if you talk about Arizona, I think homes in Phoenix were selling for something like 25 or 30 cents on the dollar. Same in Henderson, Nevada, same in certain parts of Florida. And so, big private equity.
Yeah, Cape Coral, I could tell you, or I reported on Miami, which in many respects was an epicenter of subprime. Miami is now arguably one of the most expensive cities. I mean, various things have happened. A lot of institutional money has moved down there. That was that pandemic trade for the state tax and whatnot. And again, I don't mean to hammer this so much, things that we absolutely could not see around the corner.
No, it was impossible. When you're in the middle of one of those events, and that really was as close to a 1929 experience as we've ever come in our lifetime, right? Like I said, the 87 affair was more like a professional event. The dot-com bubble was Nikkei-like, except it didn't go on for as long. And then we recovered pretty quickly because ultimately there were new technological advances that followed on relatively fast, whether it was the iPod or the iPhone. And so all that stuff that was going unused, dark fiber, all the technology and infrastructure and plumbing that was laid ultimately got absorbed by another wave of technological innovation.
So what makes the United States so exemplary with this? For example, everybody says to you, but what about Japan? You know Japan really well, right? I mean, we want to go back to 1989 and what people were talking about in the late 80s and Rockefeller Center and the one or two udon bars dives that still remain on 48th Street. But
cattle ranches,
Cattle ranches. What is it about us that do we do creative destruction better? Do we do bankruptcy and liquidation and reallocation of things better than some of these other economies do, that our market seems to rebound always?
Well, we do it, right? I mean, you didn't see bankruptcies in Japan. You saw lend, pretend, and extend for an extraordinarily long period of time, right? We thought at one juncture, I remember doing this because we were talking about it on CNBC. When the Nikkei had fallen from nearly 39,000 down to 14,000, there were estimates that the entire Japanese banking system would go insolvent because of all the interlocking ownership. The banks owned Mitsubishi Bank owned Mitsubishi Heavy Industries, owned Mitsubishi Motors, owned, this, that, and the other thing. So when all the leverage went into reverse, you thought the bankings were going to go completely insolvent. They just sat on this, didn't recognize any of it, didn't deal with it, which is why you had 30 years of lost time and economic growth and almost a permanent state of deflation there up until recently.
Culturally, there was so much invested in being a salaryman and being dedicating your life to this place, staying late, partying late, not seeing your kids, that everybody would stand on ceremony and that companies would not lay off or restructure. So for our lay listener, there was just a lot of zombie companies going on.
Yeah, absolutely. And look, we have some of that today. I mean, a lot of unprofitable companies in the Russell 2000 and that index has done reasonably well this year. But when it comes to like a large scale effort, and again, at the end of the day, we seem to, however hard it's been, have done the right thing, certainly after the internet bubble burst, although it was also followed almost immediately by 9/11, the corporate scandals of Enron and Tyco and all that type of stuff. So that was a
long forgotten.
Yeah, but it was a 2.5 year bear market, right? I mean, but the economy rebounded quicker in that event. In 08, it was a little different experience, but we did do the right thing. We liquidated stuff that was supposed to be liquidated. You had people come in and buy the bottom. You had policymakers, by and large, particularly at the Fed, do the right thing. Stimulus was probably never big enough post 08 to really, get the economy going as quickly as it might have otherwise grown. And we'll find out what happens this time around, right? If and when that day comes that the AI bubble bursts. And, as you mentioned, we're spending trillions of dollars on AI infrastructure. As a percentage of GDP, this infrastructure build out exceeds any other in history, including railroads. So there's been nothing like this, and particularly not at this speed and of this magnitude in American history. And for whatever technological revolution we've had, and you can count turnpikes and canals, you could count railroads, you can count automobiles, electricity, radio, television, computers, the internet, housing as a weird kind of variant of that, and now AI. This is bigger as a standalone experience than anything we've experienced previously. So we'll see what the other side looks like. I mean, I have my doubts that the pace of growth can continue. I'm worried about the way in which it's being financed. There's way more debt in the system than anybody's willing to acknowledge. We talk about it. Actually, I talk about it a lot. When you look at the off-balance sheet obligations of these big hyperscalers, the Journal, identified it a couple of weeks ago as $3 trillion in commitments, whether it's lease agreements,
off-balance sheet financing, you say. I'm old enough. Look, Ron, I have a beard now. I can twirl it in like a Jeff Skilling Enron fashion. But before we go to break, I would like to pose the, Tootsie Roll commercial question to you. You naturally remember, how many licks does it take to get to the Tootsie Roll? 1, 2.
Yep.
I grew up on that thing. My version of that, it's a meaning of life question to you. Ron, in your investing career, in your college career, whatever it was, let's go back to you being a greenhorn in 1984 in Los Angeles for the predecessor to CNBC. When was it ever normal? Right? We weren't in war. We weren't in inflation. We weren't in a deep recession. Rates were normal. The markets were normal. We had trend employment, full employment, but inflation was under control. Nothing exogenous happening. Talk to me.
93 to 2000.
That was normalcy.
Yeah. Well, look, we had the peace dividend because the Soviet Union collapsed. The Berlin Wall came down. We spent less on defense. By 2000, we had a budget surplus, no deficit. And you had, above normal rates of growth with below normal rates of inflation and a red hot stock market and in a certain sense, shared prosperity that was more broadly distributed than anything we've seen before or since, except maybe for the 50s and 60s.
But isn't that abnormal?
Yeah, of course.
When you scale it, when you log it back and look at the rest of the chart?
Yeah, I think what we perceive to have been as normal, that was just from my perspective, that was the easiest period of my life, right? In so many different ways. You're not going to get drafted, right? There was no hot war you had to worry about. There was, again, the dissolution of the Soviet Union from 89 forward was a very, very big deal. And we even thought Russia was going to go democratic and capitalist, right? At that point, China was, joining the family of nations without.
But I can argue that long-term capital management collapsed when I passed my Series 7 and the Fed came in and cut rates and put a lot of sugar into the system for 99 and 2000. I can't isolate a year, right? There was a bond blow up in 94, right? There was still with Orange County, the SNL crisis. I can't find any year. And it's one of those things where it depends. Anyone you ask, it's such a Rorschach. I came back and there was the GI Bill and you could buy a house on your GI winnings.
They had to go through the Depression and a World War to get there. Right.
So is it a pointless question to ask, like when PIMCO posed the new normal in 2009?
Yeah, I mean, look, I don't know that it's pointless. I think, and everybody, it's funny. I'm going to default to my late mom on this one. When she was not a fan of Donald Trump's, and my mom passed about 10 years ago, and she was terrified that he was going to be elected president. And she was worried about the world. And she was, almost 91 years old. And she's like, I'm like, Mom, what are you worried about? You were born in 1925. You lived through the Depression. You were a riveter in World War II. My dad served in South Carolina as an MP. You went through the Cold War. You went through the Korean War. You went through the Vietnam War. You went through inflation in the 1970s, hyperinflation in the 1980s. You're still walking around. I'm like, it's like at a certain point, it's like you've been through all that in your life, and you had a full life. At a certain point, you're like, yeah, this is how the world works. What was I watching last night? Oh, yeah, I was watching Lioness last night. And she was talking about the risks. Zoe Saldana was talking about the risks with her husband. And she goes, the first leader to be assassinated was an Egyptian pharaoh in 2300 BC. And she goes, this isn't different. The world has always been like this. And I was just like, yeah, that's about right.
Full disclosure, we are with Ron Insana. Please do stay with us. Full Disclosure airs on NPR, YouTube, Spotify, Apple, all of the fine podcatchers. Smash that follow button. You can get them all at one neat link, fulldradio.com, fulldradio.com, because right now it's only my mother-in-law who listens or watches my show. So please help a brother out. We are on all the social media handles. You can find me on Instagram, LinkedIn. I'm sure I still have a MySpace or Friendster account somewhere. And follow me. Catch me every week on both NPR's Here and Now and CNN. And stay tuned for some big news about some honking big live shows. I'll post all the details again, fulldradio.com. If you are just joining us, it is a joy for me. It legit warms my heart to have Ron Insana on this show. I'm looking at the shot clock. You know what, Ron, this feels like? This feels like you're coming on the last season of The Wire and you don't want it to end. Someone who's been so instructive, like when I was dreaming of becoming a journalist and when I did my first TV hit and I got to meet Ron and then I got to do events with him afterwards and I got to profile him. So in this postmodern, post-apocalyptic sense, for us to be just buddies on a split screen. You don't have to care where I am. You don't have to care where he is. It's just a blast for me. And I digress as I normally do. He of course Substacks as Message of the Markets, and you see him all the time on MS Now, which I love to see. And I won't say I grew up. I took my bar mitzvah money and I followed him on CNBC for much of the 90s and into the aughts. Ron, you were talking before break about the extent of this AI build out, which even if you normalize inflation adjusted railroads, dark fiber, anything that we built out post-World War II, it just blows all those away. What is the payoff, right? I mean, you ultimately, is this a B2B thing where these guys are building out, making these gigantic data centers, forking a crap ton of money over to NVIDIA and building compute, what it's called. Ultimately, you have to charge someone and make this a cash flow positive, IRR positive investment.
Yeah, and we don't know, right? I mean, there's so many questions about this. Like, number one, will businesses adopt it at such a pace and such a scale that these companies that are currently spending, individually hundreds of billions and collectively trillions of dollars for what we now, in the vernacular call compute, which used to be, I guess, computing power, computer chips. I don't know how the language changed so that we have compute, we have inference, which is really just
a token, which I still can't explain to my mother-in-law.
No, and the token maxing and all the rest of that type of stuff that, each one of these events has had its own lingo. I mean, you'll remember eyeballs and all the rest of that during the internet period. I don't know. Look, I mean, obviously businesses are going to use it to enhance productivity and profitability, and we'll see the extent to which that happens. And there are worries, justifiably, that it's going to disrupt employment for low-level workers, entry-level workers. If you listen to Dario Amodei from Anthropic, 50% of all entry-level jobs are going to go away. 50% of middle management jobs are going to go away. Sam Altman over at OpenAI says, listen, eventually we're just going to lease intelligence back to you like a utility. And they're wondering why there's a backlash, right? Not to mention the fact that data centers in particular, localities, at least arguably drain a lot of water, create noise pollution, and also at the end of the day have a lot of jobs up front in the construction of the center, but not a lot of jobs to operate them on a permanent basis. So you can understand not just the financial questions that those in the markets are asking, but the fundamental questions about what's the value to us at the end of the day. Are we going to also get dumber when we start leasing intelligence back, from a machine that gives us all the answers we need to know? It's such a multifaceted set of questions, but fundamentally from a financial market perspective, will they make enough money to pay back the trillions of dollars that they're investing in all this? And right now, I don't think anybody has a good answer. I think some of us are a little skeptical that they'll get the return on investment that would justify the multi-trillion dollar, valuations across 5 or 6 different companies that we see today.
How are you using Claude and or Chat GPT, and how, like, if that value proposition is a killer app, like this changes everything. This is indispensable to me. I don't have to hire 2 analysts or 2 associates. I could get this to crunch the numbers for me.
So I don't do that for a lot of reasons. Number one, I don't have to crunch numbers. Number two, I write in myself, but I do use it for research. I use it actually in a lot of ways as a glorified search tool. That's the way I interact with Claude, and more so than ChatGPT at this juncture. My kids, on the other hand, one of whom works at a fintech startup, my youngest daughter, is using Claude in every conceivable way. I mean, for just building out schedules, building out, different applications that they need, working on social media scripts and hooks that make the social media presentations that they offer more viral. And so it's more native to my 3 Gen Z kids than it is to me. I've never let anybody write a book for me. I've never let anybody, write for me personally. I never will. And I don't think I'll ever let Claude do it. I can't stand the way.
But is Claude even that dependable? If I say compare the S&P 500 versus equal weight exactly since March 9th, 2009 or March 10th, 2000, right? And it does something and it says, I'm kind of sure about this. And then I come back and I say, are you sure? And it's like, you're right. Let me go back and interpolate. And so it's not as dependable as a Bloomberg or even a Yahoo Finance. I'm not ready if I have to babysit it so much. And look, I don't mean to complain generationally, but
right.
If they want my money,
sounds like, right?
Andy Rooney on 60 Minutes. Well, what is it? What is it with this token laundry? But do you know what I'm saying, Ron? Like, if they want my money, like, you got to prove your love to me.
Yeah. And look, I do think it's, the speed with which it can give you an answer, for a rather complicated question is extraordinarily impressive. By the same token, and I didn't mean to use that word that way, the whether or not inputs or answers or predictive capabilities for AI are going to be really dependable, to me is an open question, right? Because it's great at pattern recognition. It's great at pulling data. Can it see around a corner? And that's the one question we haven't answered yet, right? Can it accurately tell you what's going to happen? Remember that it's all it's doing is pulling the collective knowledge of humans who are fallible. Right? I mean, so at a certain point, and I've seen this in the fintech that I was involved with for a while, it can't see around certain corners. If the data aren't there and something unexplained or something unanticipated happens because there's no precedent for it, it's not going to catch it. right? It has to be embedded in the data. It has to be part of the pattern recognition process. And so, the proponents of this are arguing that eventually it's going to be so much smarter than us that it'll see around the corners. Well, I do see the use case is, speeding up the drug development process, assisting in,
oncology. I could tell you from personal experience
absolutely.
that not a third pair of eyes, but a 3,000th pair of eyes, right?
Yeah.
On skin cancer people, on lesions, on looking at MRIs and CTs. I mean, it doesn't replace humans necessarily, but it's an excellent benchmark.
Yeah. And I think, to me, that's the most exciting part about it. When you look at the mRNA vaccines for pancreatic or for melanoma that are getting accelerated development because they're using large language models, they're using, machine learning, they're using AI to accelerate their processes and identify things more quickly. I think that's really interesting. Whether I want it thinking for me is a different thing. Now, again, that is a generational issue, right? That's, look, I was the remote when I was a kid, right? I mean, my dad wouldn't get out of the chair.
Switch it.
3 channels and rabbit ears and punching the side of the TV. So,
I know it.
And that generation was like, when they saw a computer, they're like, what the hell is this? And so even color TV, God, I mean, I think we got one in 1967 and it was such a, mind blowing thing that, you went to color and then you moved on to, new and different technologies, and older folks were kind of like, I'm not touching that stuff. It's voodoo. And I think generationally, now that I'm on Medicare, you have something of an aversion, although my kids are really, I have to say, my kids are pressing me to adapt and become more adept at this stuff in order to lengthen whatever career I want to have going forward. Right. So they've been really riding me, and not without results, I have to say. I mean, it's working in my Substack. It's working in my, Instagram following. It's my daughter's taught me how to create hooks that the algorithm catches onto and pushes your videos out, to more and more people. And, if
are you skibbity 6767? I don't know. I mean, do you speak that language? Ron, meanwhile, I'm just still excited I can deposit a check on my smartphone. I mean, I know.
I mean, look, I still make lists by hand of things to do, and I still do my budget by hand on a legal pad. There are parts of me that are really, really old school in that regard, because for me, that tactile experience just reinforces things in my head. And by the same time, I'll also turn to my computer and, get on Claude or get on Gemini or whatever and look up a bunch of stuff and try to find so much faster answers for questions that I have as I'm, writing or doing other types of work.
Ron Insana, one of my favorite market minds. Indeed, he Substacks as Message of the Markets. You also see him on MS Now. I do have to talk about this interest rate environment right now.
Yeah.
Let's see if you could remember muscle memory when you were that greenhorn at the predecessor to CNBC in 1984. Where were 10-year and 30-year treasuries yielding?
So we were coming down, as you'll recall, when Paul Volcker was chair of the Fed in 1980. He had taken short-term rates up to 20%. The long bond was at the 30-year treasury, which was then the benchmark, was at 14%. So we were on our way down. I think when I started, it was probably a little under 10 in terms of 30-year treasury, and short rates had come down a lot at that juncture. And then as we were moving through 1986 and 87, they started going back up. And I think it was from April of 87 to the crash of 87, 30-year treasuries went from about 6 and change to almost 10, which helped precipitate the crash because the Fed was tightening at that time under Alan Greenspan, who had just taken over for Paul Volcker. So it was in that neighborhood. What we have today is actually a fairly normal historical rate structure, right? You've got Fed funds below 4%. I mean, curve's a little flat. You've got the 10-year at, whatever it is, say 466. These are really normal interest rates.
Why do so many people freak out about a 10-year?
We were at 0 forever, right?
And that is a criticism of the Federal Reserve kind of managing this.
Well, it's easy
micromanaging this. If you've had many of the years since the turn of the century, you've had emergency interest rate policy, and arguably for too long. And then people seem like they have in their minds, maybe it's anchoring somewhere that I should be able to always get a mortgage for no more than 6%, or I should be able to borrow at this percent. And reality is that what is normal in terms of an interest rate environment right now? For example, I'll say this, Ron, 30-year, which used to be quoted as the 30-year bellwether bond back in the day on CNBC, right? The government is hugely profligate. They talk about this $40 trillion debt. I don't feel like in any way loaning my money to the government for 5.75 points over 30 years. I want more protection. I want more interest, and that's only fair. And Ron, I mean, if there's a competition for capital, these hyperscalers and others, this should run up interest rates. This is normal.
Our Treasury Secretary wants to buy bonds and put a lid on the long-term rate, particularly the 10 and the 30 year.
So talk to us about that.
Yeah, that's not a great idea. And Stan Druckenmiller, who was Scott Bessent's, mentor effectively at Soros and beyond, wrote an op-ed in the Journal this week saying, look, don't interfere with the market signal. If rates are going to go up because of this profligacy on the part of the government and because you've got crowding out from the hyperscalers borrowing trillions of dollars as well, interest rates should reflect that and should be the item that imposes discipline on people who borrow money. Right. So if you're going to interfere with that message sending signal, then you're doing a disservice to your own government that you're part of. Right. And you're telling.
But here's one pause is we've shattered that taboo several times. Coming out of the subprime crisis, they go in and buy bonds. They go in and buy mortgage securities. The Japanese, as you know, went out and bought equities outright. In this case, the Treasury Secretary is worried that Japan is going to have to sell some of its Treasury holdings, thereby allowing yields to go up more if you have to compete more for buyers out there. And so there's this extraordinary, you talk about off-balance sheet measures. This isn't the Fed doing it. This is the Treasury Secretary working in cahoots, to buy bonds in a half-hearted effort to keep rates down?
Yeah, well, certainly half-hearted for sure. And they don't have the firepower in a $32 trillion market. Even though they have $1 trillion, rainy day fund, if you will, that's the regular cash balance that they're keeping on hand to overwhelm. They can't overwhelm the market. They can, maybe make some and have some impact at the margin, which they've had over the last couple of days. At the end of the day, if the bond market ever freaks out about something, rates will, shoot higher no matter what. The thing is that this is not the Treasury's purview. And just going back to the low interest rate, the zero interest rate environment, I think when people criticize the Fed, I think they do so somewhat unfairly, except in this respect. When it comes to the great financial crisis, the Fed and others were certainly lax about credit. It was allowed to expand too much. It was allowed to get too cheap in the real world. And then when the system collapsed, they had no choice but to take rates to zero and launch quantitative easing during the financial crisis or during the pandemic when we literally shut the economy down and kept everybody home for an entire year. They didn't have many options, right? You had to flood the system with money if you didn't want a depression, right? So should they have raised earlier? Yes, arguably, but we didn't know what the Omicron variant of the pandemic was. We didn't know what the Delta variant was. We didn't know if the vaccine was going to work. We didn't know when we were.
We didn't know that ChatGPT was around the corner.
Yeah, right.
And companies would have $5 trillion market values, right?
Yeah, there were a lot of things we didn't know. So, you can beat up on Jay Powell all you want, and maybe he waited a little too long to raise rates. But look, these were really extraordinary circumstances. The great financial crisis and the pandemic, particularly the pandemic, were things we'd not seen, let's say since 1918, right? Where you had a war and you had, a worldwide pandemic that literally stopped the global economy in its tracks. So I don't want to beat up on the Fed too much. I don't think this is the job of the Treasury to try to hold down interest rates when we have a $1.8 trillion deficit every year. I think it's incumbent upon the federal government and Congress to do something about deficits. In the same way, the Simpson-Bowles proposal, which came out in 2010, would have tried to right-size spending and also, make the proper investments in infrastructure, education, and so on and so forth.
Close us out, Ron. I love having you so much, and I want this to keep going on. In the words of Sting, right? If you love somebody, free, set them free. And I know you're in demand. You're going to be called for another TV or radio. I love this so much. I could do, if anybody wants to sponsor us, like on an Insana GI Bill fellowship, this is gravy for me. This is bonus time. But what should we be talking about? Obviously, people buttonhole you about persistent inflation. That is a hard beast to slay. And oftentimes in the Volcker market that you studied in the early 80s, you had to throw the economy into a deep slowdown to break that inflation.
Yeah, and there were really two different kinds of inflation. When you go back and look at that experience, right, it really started in 1966 in the Johnson administration. People who aren't our age won't remember the guns and butter argument, but we were spending money on a war and spending money on social programs and beginning to do so in size. And so that helped to start generate inflation. Then you had Nixon take us off the gold standard. You had the Arab oil embargo. You had policy mistakes coming from the Fed and from the federal government. And then you had as you know, the Iranian Revolution in 78 and 79. Both those oil shocks were instrumental in driving inflation to double digits. So in 1980, inflation was 13%. Unemployment was 11%. Short rates were 20%. We're not in that kind of environment yet. If we keep down this path, 10 years from now, we certainly could be. 5 years from now, it could be a lot worse. Yeah, maybe the Fed should be tightening here. Hard to tell. It's a really tough call because the labor market's softening, even as inflation remains sticky. We've got this mini stagflation thing going on. My guess is the Fed should probably tighten a couple of times and then sit back and see what happens.
How do people who are paycheck to paycheck or do not have an abundance of capital in the system handle something like that?
They
right?
don't.
Using credit card debt to fund grocery purchases or trying to make rental ends meet. And I don't want to give into the cliche of two economies, but that's the thing. If you're in stocks,
it's three.
Tell us.
So I'm contemplating. I said this on MS Now, and I probably shouldn't have, but I am contemplating a book called The E-Shaped Economy, because when you look at what's happened, you have a new aristocracy or oligarchy, whatever you want to call it, right? That is just uber wealthy, mind-blowing amounts of money. Then you have a portion of the middle class that we used to count on as being stable that migrated up to, six-figure salaries and above, still challenged a bit, but they're making enough money to do well. The traditional middle class of $50,000, $60,000 folks are getting really hurt by this inflation, because you can look across the spectrum of things that are expensive, including housing, and they're not making it. And then you have this almost permanent underclass who not only aren't making enough money, but they're having their Affordable Care Act subsidies eliminated. After the midterms, Medicaid's going to get cut, SNAP's going to get cut further, so food stamps are going to be less available. And I think you've got now, the makings of a very, very difficult environment for a lot of people, many more than we're willing to recognize. And so I think when you look at it that way, Scott Bessent, our Treasury Secretary, may be tired of hearing about the K-shaped economy. He's going to start hearing about the E-shaped economy pretty soon, and it's going to be much less appealing, because at least in the K-shape, you can climb back up that bottom rung. If you're stuck on the bottom rung of the E, there may be no escape. So I think that we're getting into a very dangerous place where the income inequality, which we've been complaining about since really the 80s, is so extreme now. When you have someone who is close to being a trillionaire and you have other people who can't even get food stamps, that's the recipe, not only for economic upheaval, but ultimately political upheaval as well.
And you don't want to extrapolate too much from New York, but when you have Zoran Mamdani out there actually listing the values of hedgies who are absentee holders of capital out there, smacks a little bit of French Revolution, Sans Culotte and others is out there. He's a really charismatic guy, and it has a lot of capital holders terrified and fleeing to South Florida.
Yeah, I mean, listen, Ken Griffin's left, and their hedge fund managers have moved down there and have moved their offices as well as their homes, and you got the pied-à-terre tax and all the rest of that. But yeah, I mean, it's not. I don't think it's full on French Revolution time, and I don't think that's where we're necessarily going. But yeah, if you've seen Les Mis enough, and I think I've seen it 5 times, you get a feeling for what abject poverty looks like versus a near aristocracy. And the gap is just so incredibly wide that, I would never say, no one should be a billionaire or no one should build a business that makes them wealthy. But when you start talking about individuals who are trillionaires, it's just such a mind-boggling number. And it comes with it. What comes with it is mind-boggling power. You start to disenfranchise people, and there is ultimately, I think, both an economic and a political price to pay.
Ron Insana, message of the markets, so much love. I mean, have you had enough PDA? I mean, I just want to send a letter to myself in 1998, watching you and Faber and Bill Griffith and Sue Herrera. I believe I had my first TV hit with her on the floor of the stock exchange. She held my hands like, you're going to be fine. We're talking about the JetBlue IPO.
Yeah, absolutely.
You guys, so much love. I hope it won't dilute your LinkedIn profile too much if I suggest you are a friend of full disclosure.
Not in the least, 100%.
Oh, my heart. Ron, come back on anytime, literally.
Love to. Thanks, Robin.
Thank you. Full disclosure, special thanks to Ian Stewart. If you are listening to us on the radio, note that while we cut for broadcast link, the entirety of every interview is on podcast. We are on the NPR network, Spotify, Apple. Watch us on YouTube. You could find them all at one link, fulldradio.com. Again, fulldradio.com. And please do recommend us to a friend. A shout out to our home station, WVTF Radio IQ, Virginia's NPR news source. DM me to carry us on your air, and catch me every week on both CNN and NPR's Here and Now. I'm Roben Farzad. Thank you for listening. Back with you next week.